Hello everyone. For this week, we will have two videos. The first video is presented by myself, covering Benford's law analysis and some other functions in ACL and IDEA. The second part is taught by Hussein Issa, who is currently an assistant professor at Rutgers Business School. He will explain his research on duplicate payments. So in this video, I will start by discussing a very useful technique for auditors to do data analytics, Benford's law. After that, I will show you how to do other functions in ACL and IDEA. For Benford's law, I will first discuss the history of it and what exactly is Benford's law. After that, I will talk about what types of data that conform with Benford's law and how it can be used in fraud investigation. I will demonstrate this by using examples. Finally, I will discuss the other uses of Benford's law and the cautions that we need to consider when using Benford's law. The discovery of this law dates back to 1881. An American astronomer, Simon Newcock, noticed that in logarithm tables, the early pages, which contains numbers that started with 1, were much more worn than the other pages. This became the first known observation of such law. Newcock proposed a law that the probability of a single number n being the first digit of a number was equal to log n plus 1 minus log n. For example, if n equals 1, then it should be log 2 minus log 1, and it's approximately 0.3. The phenomenon was again noticed in 1938 by a physicist named Frank Benford, who tested the data from 20 different domains and was credited for it. His dataset comes from various sources, including surface areas of 335 rivers, the sizes of 3,259 US populations, 104 physical constants, 5,000 entries from mathematical handbooks, 308 numbers contained in an issue of Reader's Digest, the street addresses of the first 342 persons listed in American Men of Science, and 418 death rates. The total number of observations used in the paper was 20,229, which is considered as extremely large at that time. This discovery was later named after Benford, so we call it Benford's law. In 1985, Hill proved the results of mixed distribution. Benford's law was first used in accounting in late 1980s. Here we have to mention one important person named Mark Nigrini. Mark Nigrini was a pioneer of applying Benford's law in auditing and forensic accounting. In his groundbreaking 1991 Journal of Accountancy article, he introduced this useful tool into accounting world. He showed the widespread applicability of Benford's law and its practical usage to detect fraud, errors, and other anomalies. Mark Nigrini has written many books regarding Benford's law and its usage in accounting and auditing field. One of his latest books is called Benford's Law: Applications for Forensic Accounting, Auditing, and Fraud Detection. If you are interested in this topic and this technology, you can find this book on Amazon. So what exactly is Benford's Law? Benford's Law gives the probability of obtaining digit 1 through 9 in each position of a number. What is the position of a number? Well, let me illustrate it with a simple example. For example, for 3,879, the number on the first digit is 3, on the second digit it's 8, on the third digit it's 7, and on the fourth digit it's 9. Intuitively, most people tend to assume that the probability of a number appearing on a digit is the same for different numbers. For example, for the first digit, people incorrectly believe that the probability of number 1 appearing on the first digit is 1 over 9, which is the same as the probability of number 8 appearing on this digit. However, in reality, this is not true in many cases. According to Benford's law, the probability of obtaining 1 in the first digit position is about 13.1%, which is log 2 minus log 1, as I explained before. So this table summarizes the expected frequencies of different numbers appearing on different digits, calculated using Benford's law. As you see here, on each digit, there is a decline probability from smaller numbers to larger numbers. On the first digit, the probability of number 1 is largest, almost twice likely as number 2. The probability of number 9 appearing on this digit, the first digit, is very small. It's less than 5%. On second digit, the difference of probabilities between different numbers is smaller than the first digit, and this pattern applies to the third and the fourth digit. In practice, you don't need to calculate this yourself, although it's very simple. But you need to have this idea in mind that the probability of different numbers appearing on a digit is not the same in many cases. So you may ask, why is it that there is such a seemingly strange pattern? There is actually a clear logic behind this. Let's consider only numbers on the first digit. If a data entry begins with the digit 1, it has to double in size, which is 100, before it begins with the digit 2. For example, from 100 to 200, or from 1000 to 2000. However, if a data entry begins with the digit 9, it only has to be increased by 11% in order for the first digit to become 1. This is like, increase from 900 to 1000. You may realize that this law is not applicable in all circumstances. This is why I keep saying Benford's law is useful in many cases, but not all. For example, if the number is generated randomly, then this law does not apply. In fact, Benford's law is only useful for certain type of data. So this table summarizes the types of data that conform Benford's law with examples for each type. The first type is the set of numbers that come from mathematical combination of numbers. Results come from two distributions. Two obvious examples are accounts receivable and accounts payable, because they are both products of two variables that come from two distributions. Auditors can use Benford's law to test whether accounts receivable or payable is reasonable. Another type of data that follows Benford's law is transaction-level data. However, it is important to note that there is no need to sample when applying Benford's law. You can simply check on the raw data, such as disbursement, sales, expenses, to see if there is any violation of Benford's law. The third type of data that follows Benford's law is large data set. The more observations, the better, meaning the more reliable the result. This could be full year's transactions. Finally, accounts appear to conform when the mean of a set of numbers is greater than the median and the skewness is positive. This result comes from mathematical manipulations, and we don't need to consider the detail of it, but actually most accounting numbers fall into this type, so suitable for Benford's law analysis. Now let's discuss on what situations the data does not conform Benford's law. First, if the dataset is compressed of assigned numbers. For example, zip codes are assigned rather than occur naturally, so it does not conform Benford's law. The same applies to check numbers or invoice numbers. Also, numbers that are influenced by human thought are not applicable. For instances, many prices are set at psychological threshold, such as $1.99 or ATM withdrawal amounts. A third type of data that do not conform Benford's law are accounts with a large number of firm-specific numbers, such as an account that are specifically set up to record 100 refunds. If an account has built-in minimal or maximal, it will also reduce the usefulness of Benford's law, like the set of assets that must meet a threshold to be recorded. And lastly, when no transaction is recorded, Benford's law is not applicable. So to summarize, accounting data that can use Benford's law include accounts payable data, accounts receivable data, estimation in general ledger, relative size of inventory unit prices among locations, new combinations of selling prices, customer refunds, and duplicate payments. Now I'm going to give you some examples of the use of Benford's law in fraud detection. The underlying reason that Benford's law could be useful is because invented or altered numbers are not likely to follow Benford's law as random numbers do. In essence, human choices are not random, although we do not realize it ourselves. Benford's law, however, can easily detect such manipulation. One famous example was in 1993, which is a case between state of Arizona and Wayne James Nielsen. The accused was found guilty of trying to defraud the state of nearly $2 million. Nielsen, a manager in the office of Arizona State Treasury argued that he had diverted funds to a bogus vendor to demonstrate the absence of safeguards in a new computer system. 23 checks were manually created. These are carefully designed so that the numbers appear to be random. There is no duplicate payments. All the values include dollars and cent amounts. However, because Benford's law is quite counterintuitive, people do not naturally assume that some digits occur more frequently. So subconsciously, the manager repeated some digits and digit combinations. Among the first two digits of the invented amounts, 18.7, 18.8, 19.3, and 19.6 were all used twice. For the last two digits, 16, 16.7, and 18.3 were duplicated. Note that 7 through 9 were the most frequently used digits, in contrast to Benford's law. Even though Mr. Newsom believes that his choice is random, but Benford's law shows that this is not random but invented. Now let me show you how to conduct Benford's law analysis using ACL. Remember, last week we have imported accounts receivable and accounts payable data. In today's lecture, I'm going to use accounts payable data. So let's go to the table first. And from this table, you can notice the amount field, and this is a variable that we are going to use for analysis. So if we choose analysis, perform Benford analysis, and it asks you to select on which field you want to do Benford law analysis. And here it will list all the numeric variables. However, if you remember, we just discussed what kind of data that does not conform Benford's law. Check number is one of them because it is pre-assigned. So here we can only choose the amount. And you can also choose the number of leading digits. And for now, we only consider the first digit. We also select to include upper and lower bounds according to Benford's law. Any value outside of this range is suspicious. You can also set conditions if you want, but now we are going to test the whole population. For the output, again, we show it on the screen. So now let's click OK. We see the results. You can see the leading digits, the actual count, the expected count, the statistics ratio, lower bound, and the upper bound. If you have studied statistics, you should be familiar with this value, this statistic ratio, as well as t-value and f-value. If the actual count is smaller than the lower bound or larger than the upper bound, we see these cases violating Benford's law. In this particular case, we see number 1 has 188 counts, which is smaller than lower bound. For number 2, the actual count, 154, is between lower bound and upper bound. For number 3, it also falls into reasonable range. So does number 4. For number 5, it is a little larger than the upper bound. Number 6 has 90 counts, which is also above upper bound. For number 7, it is much larger than the upper bound. For number 8, it is inside the range. For number 9, it is above the upper bound. While it is difficult to see from the tabular format, remember that we have covered how powerful visualization could be. ACL automatically generates a graph for this data. So simply go to here, graph. So here you can see the actual value, the expected value, which is in the middle, the upper bound, and the lower bound. You can see that the actual value for number 1, it is most remote from the range or the expectation. Another obvious deviation is number 7, where it is much larger than the upper bound. For other numbers, they seem to comply with the law or deviate only a little bit. Then you may want to know the results when using the first 2 digits. So we go back to account payable, analyze, perform Benford analysis. We change the number of leading digits to 2 and also include upper and lower bounds. Click OK. And now you see many numbers. Since these are first 2 digits, there are 19 lines. In this case, it is convenient for us to see the trend using graphs, as it is shown here. You can see that while most of the numbers are acceptable, but for number, I think it's 79, it has significantly larger frequency. Also, it is true for number 75 and 76. In this case, we need to extract these 3 parts of record to do further analysis. So what we can do is to go back to the table and find the record, and find the records starting with 79, click it, and we can see all the records with a month starting with 79. So if we want to extract this to a new table, so you can simply go to data, extract data, and here you can choose to either to extract all the fields or only extract a subset of the fields, and set the condition of the extraction and name this. For example, we see that we could name it as account payable $79, and OK. Then we can see this new table. But here we only extract the month field, so we delete it, and we extract again. So data, extract data. We extract all field and call it account payable 79. Okay. Yes. Now we extract all the fields of this the records that satisfy this condition. Now let's go to idea to see how to do the same thing. Also, we first come to the account payable table, and then we choose the analysis, Benford's law, and here again you can choose a field to analyze, and we choose amount. And in idea you can choose to include positive values or negative values, because you can see here all the amounts are in positive values, so we choose positive, and again we choose to show boundaries, and mean absolute deviation. Here you can see that there are many tests that you can choose, like you can work on first digit, first 2 digits, first 3 digits, or second digit, last 2 digits, and so forth, and it will automatically create names for these databases. And here, if you go to advanced, you can choose the minimal records in input database. Here, because we only have 999 data, so we choose 999 and choose OK. OK. Now you can see several results here. If you want to switch between them, simply click this one, or this one, or this one, and you can switch between different results of different tests. Or if you go back to the account payable, and you can also choose Benford's law to see the result. When you click the result on the second digit, like what I did here, you would see that number 2 is significantly lower, while number 9 is significantly larger than the expected value. Then let's go back to the results of the first 2 digits. If you want to extract data, you can click the bar, which is highlighted here. You see, highly suspicious, suspicious. And for this one, remember, we have discussed it before, is 79. So if you want to extract this record, so you can click it and choose to extract suspicious records, display suspicious records. So you can choose to extract the records, and then if you give it a name, it will create a new table here. And you can also choose to display this record first and choose to save it. And this will also create a table, a new table that satisfies this condition. Now suppose we extract it and name it as account payable 79. Okay, and all the records are listed in the new table. Now when you look closely to these records, you would see that many are just above 79,000, and among these records there are only 3 authorizers: HMV, BC, and WJT. So one possible explanation is that there are amount limitations that they can authorize for each transaction. In order to approve transactions larger than that amount, they have to split these payments. Usually they split them just below the limitation. That could be the reason why there are so many records that is between 79,000 and 80,000. But notice that this is only one explanation, and it could be misleading. For example, if in total there are only 3 or 4 authorizers, then it is absolutely normal that the number of distinct authorizers for these transactions is 3. So you need also to check the number of distinct authorized persons first. This is a type of data analysis that auditors need to do, to generate a hypothesis, but use other ways to look at the data to exclude possible explanations, and the only thing left is the truth. Now you have seen how to use Benford's law to detect suspicious transactions. There are also other uses of Benford's law. For example, it can be used to solve year 2000 problem. It can be used to allocate computer disk space. It can detect irregularities in clinical trials. It can be used for demographic models of population statistics, and has many other usages. If you are interested in this topic, you can search online and you can find many interesting articles. So when you are using Benford's law, you should always be cautious. First, what you identified is anomalies, but not necessarily fraud. This causes a problem of false positive. In addition, although Benford's law is useful in detecting fraud, not all fraudulent transactions can be detected using Benford's law. It's only one tool among various tools that can be used for this purpose. Now I'm going to discuss some other basic functions in ACL and IDEA that we haven't covered in the last week's lecture. I will show you how to create expressions, add virtual field, create filter, extract data, and join tables. Finally, I will show you how to do logs in ACL and IDEA. Now, suppose for account payable data, we may want to know how many days it takes to pay the invoice. So we need to create a new field. In ACL, when you go back to account payable table, you can find two dates. One is the invoice date and the other one is the pay date. The payment date is the difference between pay date and the invoice date. We can analyze payment date to see, for example, whether there is very late payment or very quick payment. So what we can do is to go to add table layout. Here, add new expressions. And first, we name the new field as pay days. And then we can define the value of it. So we go to this expression editor. So if you see the function button, you can see many different functions that you can use. The function now we want to use is under date category, and it's called age. So we add it here. And what we can do is to put the invoice date, the early date first, and comma, and put the pay date later. This helps to calculate the difference between dates. Notice that I simply click these available fields to add them to the expression rather than typing. Now we verify and it's valid, so we click OK. Now we choose to accept entry, and it will be shown here in the table layout. So now if you go back to the table, choose one column, for example, so we just choose one column. Here we can choose to add columns, and then we can choose the new field that we created named pay date, and so select OK. And as you can see here, the new date, the pay dates are included in this table. Or you may feel it's a little bit cumbersome, so you can do another thing. We still go to table layouts, add new expressions. Here we see we create a new field named pay days new, and for the function we can simply use the pay date minus invoice date, verify it's still valid, and click OK, accept entry, and you can still see it here. and you obtain the same result. And if you add it here, it will show the same thing. Now you want to sort this variable to see extreme values. For example, if you choose quick sorting, ascending, you will find some negative days, which is quite unusual, indicating that the pay date is actually before the invoice date. So you are essentially paying something that didn't have an invoice yet. Now, if you want to extract these transactions for further analysis, so what you can do is to create a filter. So here you can choose Edit New Filter, and you see the same expression box. So here we choose pay days, and it should be smaller than 0. So we extract those transactions that satisfy this condition. We verify it, it's valid. So we click OK, and now it will show the records that have negative pay days. Again, you can choose Data, extract the data, and assign it a name. For example, negative pay days, and we extract all the fields. Okay. Yes, we made these changes, and now you can see this new table, negative pay days. Now let's go to Idea to see how to do this. So again, we go to Account Payable, go back to Data, and in Idea you should choose Data, Append, and first you assign it a name and choose a type of it. So the name we choose is Pay Days, and here you can choose a field type. Here we set it as default numeric. Then you need to click the parameter button, and it will lead you to an equation editor, which is similar to the expression editor in ACL. Here we can also choose functions that can be used here. So again, we go to Date, go to this one named Age, and on the right side there is a usage of it, as you can see here. So for the first date you put the early date, so it's invoice date and comma, and then you put the later date, which is the pay date there. Sorry, I put check number, which is pay date there. Now we try to validate it. It's valid, so we accept and exit. Well, one thing I want to mention is the field type. You can notice here that you can choose either numeric or numeric. So the difference is that if you create numeric, then you can delete that field after you imported it into the table. However, if you create numeric, it essentially means that you cannot delete it, which is the same as the original file. So for now, we just create a numeric. So click OK, and you see that this variable is created. But it seems that we made a mistake. We actually used the earlier date minus the older date. So what we want to do is to first remove this field. Okay. and then create a new field, pay days expression. Now we can simply, now again we choose the date and time, we choose age, and pay date dot invoice date. Now it's valid. Click OK. Okay. Now we see the result. Now we can double click it to sort the value, and you can see there are still negative pay days. So if we want to set criteria, here actually you can only go to on the right side there is a criteria field, and then it will lead you to a equation editor. And now what you want to do is to set pay days smaller than 0, accept the entry, and now we get this new table. Again, if you want to save this, you can go to home button, save as, we name it negative pay days. Okay, replacing it, and a new file is generated, a new table is generated. Now we have finished analyzing payment days. Now let's talk about detecting unauthorized suppliers. Remember that we have imported two datasets for account payable scenarios, one account payable data and one supplier address data. Now what we want to look at is to join the two tables first to see if all the payees in the account payable data are authorized suppliers in the supplier address data. One way to do it is to use, in ACL, is to use data join table. So let's first go to account payable, data join table. And because currently I'm opening account payable, so the primary table is account payable table. Before we join two tables, we need to know what variable we can use for joining. So let's see, in account payable we have supplier number, payee, invoice, pay days, invoice date, amount, check, pay days, and authorized person. While in supplier address, we have supplier number, supplier name, address, and zip code. So we can see we can only use supplier number for the join. Before we join these two tables, we need to make sure that these two variables have the same type of length. So for checking length, we still go to table layout, and you can see in account payable data for the supplier number, its character and the length is 4, and for supplier address, you can see its character, but the length is 10. So when we look at this field, actually we realize that 4 digits are enough to represent it. So we create a new field that contains supplier number with length of 4. So here we go to table layout, add a new expression, we call it supplier new number new, and then we go to expression. Now the function we want to use is on the string category, and it's called substring. We first need to substring, we need to trim the variable, so we set all trim, and here it should be supplier number, and because we only need 4 digits, so we start with the first digit, and the length is 4, and let's verify it's valid. Okay, and then we add this one. Okay, and now we do the same thing, add columns, we add supplier new. Okay, we can see they have identical value, but actually if you go table layout, you notice supplier and supplier new, they have different lengths. So now we can do the join. So we go back to account payable data. Yes, we go back to account payable data and the data join tables. So for the first one, we choose supplier number. Okay. And we include all fields in the output. And the second table should be supplier address. And the key should be supplier new. Okay. And this for the second field, we add all. So we want to see all the records for the output. So for the output, we need to name it like payable supplier. Click OK now. But this table only contains transactions that are successfully joined. What you want to do is actually to see those records that are in account payable but are not in supplier address. So to do this, actually what you need to do is to change only one thing for join table. Again, primary key, it should be supplier number. For this one is supply number new. Okay, and we give it a new name called supplier verification. But in the output, we don't choose match the primary records, we include all primary records. So this means that all the records on account payable table will be included in the output, no matter it is successfully joined or not. Now we click OK, primary table. Okay, oh sorry, I didn't select the field, add all. Okay, and now you can see the result. So for this one, while most records are joined, you can still see some records that do not have address information. So basically, their records are those that is not successfully joined. So for now, we can also set a filter. Again, for example, for the new table, we can choose those with supplier number equals now nothing to see those records. And you see for that records, they don't have supplier number, they don't have this supplier number. And again, you can do the same thing to extract these records. Now let's go back to account payable data. There is another way to join table. So you go to data, but here you don't use join tables. Instead, you use relate tables. So relate table is different from join table. Join is to physically join, while this relate table is only to virtually join. There is no physical table created in this project. So here you can add the table. Now it's supply address, and now you can simply join by drag and click and drag. Now for example, if you want link supplier number with supplier new. So you can simply choose like this, and they are linked. So you click finish. And now in this table, if you want to add new columns, for example, if you want to add address, so you can choose column, and from table, now you have another option. You can add columns from table supplier address. So you choose this one, and you can choose address 1, add it, okay. And you can see address information is created here. This is called virtual join. Now let me show you how to do this in IDEA. Again, before you do it, you need to verify the format of these variables. So here, you can right-click at any fields and choose field manipulation. And you can see that the supplier number is character and has length of 4, while in supplier address, if you use field manipulation, you can see supplier number is character but has length of 7. While they are in different lengths, in IDEA, it can be handled automatically and there is no need to change it. So what you need to do is to go to analysis, join, and first you want to include all the fields and select the second table you want to join, which is supplier address. And again, you want to include all the fields, and this is the name of the join table. And for match, you need to choose how to join these two tables. So it's supplier number from the first table join to supplier number for the second table. So click OK. Again, we need to choose to include all records in primary files. So OK. Now this is a joined file. Again, although many records are joined, if you click down, you can see some records with blank field, such as the one here. So if you want to extract this field, you use criteria, choose supplier number 1 equals empty field, validate it. Okay, we accept entry, and now you have the new records. Again, you can extract this by go to home, choose save as, and create a new table. Now, remember that when I first introduced these two tools, I said that one of the most important features is that they can log your operation. It allows others to track your performance and allows yourself to repeat your task easily. In IDEA, you can simply go to that table and select history. For example, for account payable day table, if you go to history, and you can see all the performance that you have conducted. Here, these are all the functions that I have done. If you go to different ones, for example, you can see the exact time that you conducted that one, and most importantly, the IDEA script code. If you are good at programming, you can also program yourself using IDEA script editor. Also, you can use this script to automate the task you conducted here. In ACL, you can see the log by clicking the tag on this corner. So log information. And it is stored by date, and if you select any particular one, you can see that it includes ACL command and also the result. So similar to IDEA, you can use this command to write your own script. Okay, this is all about this lecture. So don't forget to watch another video on duplicate detection, and also remember that your assignment is due by the end of next week, which is October 19th. So see you next week and have a good day.